Hi all, welcome to the daily charts. My name is Michael. I'm the analyst and content creator on the channel. Welcome to our YouTube video. So in this video we want to discuss, analyze and dissect the three-step strategy that basically I decided to talk about in brief in the previous 3-minute video. So again, 3 steps. Then we're going to discuss the logic behind the strategy, the implementation of the strategy, the scalability of the strategy, and the way you as a day trader can implement it without a lot of hassle, with some hopefully with some training. If you are experienced enough, maybe you don't need any training. And again, it's all a matter of acceptance. If you accept the strategy, I mean, this is a strategy that needs to work. It's not one and done. It's not gimmick here. Let's get right into it. So again, whether you saw the 3-minute video or not, let's discuss the first step. So the first step is to pick the worst stocks in the market to short and the best stocks in the market to long. But this is a very broad definition. What is the worst stock? Who are the worst stocks? So this is the list that this strategy compiled for me on Friday at the close. And remember, this is a dynamic list. So what do we want from this list? First of all, we want the volume, which is very important for us. Volume to be at least 5 million shares. So if there are no 5 million shares, any of those stocks won't belong in this list. So in order to qualify for this list, 5 million shares, which means for some stocks it will take some time. For others, it will take maybe 10 or 20 minutes to fill the criteria. Then another and maybe most important part is the range percentage. What is the range percentage? Again, I've explained it so many times, I'm tired of it, but we'll do it again for those who didn't hear in the past. So range percentage basically represents the movement in percentages that the stock is doing from the highs to the lows. So if the move is from 100 to 105, it's a 5% move. If the move is between 50 and 55, that's a 10% move. So and if the move is between, let's say, $11 and $11.10, that's a 1% move. So we want to trade, basically, being that we are day traders and our whole game is to take advantage of intraday moves because we're closing all the positions by 4 p.m. intraday moves. So we need stocks that are moving up either 20% or 8% or 5%, but we don't want to deal with stocks that are moving 1%. So again, a stock that closes 6% down, maybe at one point was down 10%. And a stock that closes down 20%, maybe we'll see on the chart, it was down 30%. Again, the idea here is to build on the list. Again, this is the first step. How much does it take to build this list? 0 time, like 1 minute per day. And again, if you don't get enough stocks into the list, you play with the characters, or basically you define. Let's say there are only five stocks on the list, so you change the criteria for volume from 5 million to 4 million. Or if there are 40 stocks in the list, you change the criteria from 5 million to 6 million. Or you play with the range percentage up and down until you get a list of anywhere between 5 and 10. At the beginning, while you are novice to the strategy, start with 5 or 6 stocks again, and go from top to bottom. So let's say stub is down 20%, and let's say now the timing is 11 in the morning, and it's down, let's say, 17%, and it's still top of this list. Down 17%. So what you do in this case, basically, if you have couple of screens, you move this stock to one of the charts in one of the screens and you follow up. Again, this is now your own strategy. So we're looking at this chart. I'm looking at the 3-minute chart of STUB. Let me make it a bit bigger. Okay, so this is the move. Now we can clearly see the gap down. Obviously, this is something that we cannot take advantage of. So the stock gaps down, then moves higher, lower, and now suddenly for more than an hour, anywhere between 12 and 1, it sits in a very narrow range above 15. So this is basically an area of consolidation. So now, let's say you want to buy the stock, you buy over the consolidation, you want to short the stock, you short under the consolidation. This is the worst stock in the market. It's reasonable to try and short it. You short it under 15 and the stock goes down to 14. So this is basically a 5% move, more than 5%, but let's call it 5% move. So the strategy tells us the following. We risk on any trade no more than 1%. And it doesn't matter if the position is 10K, the position that we are shorting 10K or 50K. That's your own decision as a trader. So if it is, let's say, a 10K position, 600 shares. If it is a 50K position, 6,000 shares. Again, this is your decision. Now let's talk about something in between. This is a 20K position. So if it is a 20K position, we are shorting here minus, let's say, 1,400 shares. Shorting 1,400 shares. Assuming there are no short issues, we short 1,400 shares, or in this case, $20,000. So if it moves down 5%, $20,000, basically at one point we will be up plus $1,000 on this trade. Plus $1,000, and basically it's half of what I suggest is your daily target. Okay, so if you're trading a $20,000 position, your daily target is 10%. And again, the idea here is that you can repeat this event on other stocks, on long plays, on short plays, and out of this 5% move, you're gonna basically pocket only 3%. So 3%, that means we pocket on this trade $600. And this is one of the trades that we're going to take during the trading day, and there will be others. So the idea here is that you make on STUB 3%. Then you trade, let me give you another example. We trade TeraWolf. Can you find, assuming we don't find an entry point and we actually lose on this trade, on whatever entry that is a bad one. Let's say we enter here a short, the stock moves higher and we lose the full 1%. So in this case, we are losing in Wolf minus $200. So two trades, one made 3%, one is losing 1%. Any loss must be capped at 1%. And now let's take a look at another potential short. Let's take a look at Trump, DJT. The stock is moving lower, and I can find an entry point with very little risk. Let's say I do, okay? Here at the VWAP, the entry is under 1150 or 1145, and the stock goes down to 11. So from 11 to 1145, that's another, I'm rounding things up, another 4%. So this trade is giving me another, and it closes at the lows of the day, so that's 4%. And I had another 3%, minus 1%. So you catch, I hope by now you catch the drift. So I'm adding to my inventory 7%, 1%. That's 6% on 3 trades. And I'm adding one, now I'm going to move to the long plays. And I'm going to make 3% on one trade, lose 1% on another, make another 3% on another trade, and maybe I'll hit a home run and we'll make 8% on one of the trades. So, but again, the idea here is that you have less control on the winning trades and have full control on the losing trades. Have your full control and max or cap. That's very important. Cap loss, that's critical, at 1%. If you do it, if you cap your loss at 1%, this is basically crucial to the strategy, because again, finding the list or the search is simple. Finding the entry points, it's your own strategy. I can help you with that if you take the class and work or the mentorship and work with that. It will take me 3 hours max to basically finalize your or the strategy that I'm looking for, and what kind of instruments or basically areas I would target as short plays or long plays. Again, the idea here is that you must keep your losses in check. Okay, so that's crucial. And then you must let, and this is actually the toughest part of the strategy, you must let the market run its course. Again, let's talk about a minute about Warren Buffett. What Warren Buffett does, he buys the Coca-Cola at $3 40 years ago. He doesn't think about making 100% on the trade, or which 99% of investors and traders will say, wow, Coca-Cola, I bought it at 3, let's sell at 6 and buy myself a new car. Okay, he says, no, I'm doing things differently. So he stays the course for 40 years. We are day traders. We don't have 40 years, but we do have 4 p.m. So instead of being a day trader that stays in a trade 5 minutes, 10 minutes, 15 minutes, let's stay in the trade 3 hours or 4 hours. Amazing things will happen. Worst case scenario, you lose 1%. Best case scenario, you will gain 7%, 10%, and in some cases, once a month or twice a month, more than 15%. It will happen. It's happening in these 2025 markets. But the average will be anywhere between 3 and 5% on a winning trade. So those 3% trades pile up. Okay, so you have 3% trades, winning trades, that's 9%. You have 3 losses, that's 3%. So you end up the trading day with a 6% loss. Win. Now, how big is your 6%? Again, scalable. If you have a $20,000 position, 6% is $1,200. If you have a $10,000 position, it's $600. And you have a $50,000 position, which is doable. Okay, it's not something out of the ordinary when we are trading high liquid 6 million shares per day type of stocks. Then the sky is the limit. One additional thing that's super important, you need to work. Meaning, forget about coming to the trading day and doing one trade at 9 in the morning, successful or not successful, and that's it. If you are doing it, that's not the strategy, that's not day trading, that's more like, kind of joking around. Okay? So, day trading is not that, the work is not that complicated and tough. This strategy is scalable, it's learnable. Where I'm teaching it, most of the students that are going through my mentorship can weather this strategy in 6 hours. Some of them in 3 hours, others in 9 hours, but most of the students are doing it in 6 hours. Which means it's relatively simple. The implementation is not simple. Why it's not simple? Because instead of waiting for a trade to develop 5 minutes or 10 minutes, what most of the traders are doing right now, and that's why they're not successful, you need to wait 3 hours or 4 hours. You don't need to add on the position, you don't need to sell half, nothing. Just run the course and do it for 6 months. And if you do it successfully for 6 months at $20,000 per position, which is nothing, and obviously if you are a US day trader, you have the capital to do it, then you can upscale to $30,000 and $40,000. I'm not talking about $100,000, but again, it's a decent way to profit. And once again, you profit, but this is not your job to profit. Your job is to protect your capital and don't risk or don't lose anything more as much as possible, than 1% for each given trade. So let's go and finish this video with another example. Now I'm going to, so if you remember, I had 13 stocks on the short list. So that's step 1 of 3. 13 stocks on the short list. And let's take a look now at the long list. And again, the criteria will be pretty much the same. So on some given days, the market is going to be very strong. So there are going to be very few stocks here. Like let's say there are 4. But if I'm moving to the long list and it's a great trading day, let's say Friday it was actually the same number, which is crazy. I mean, this is pure luck. But let's say it was the SPY was up 1% or 2%. In this list here, there will be maybe I don't know, plus 25 stocks. So you cannot deal with 25. So instead of looking for volume at 5 million, look for volume at 6 million. If you're looking at the range of 5%, increase it to 7%. So you basically ask for the search to be more, let's say, more aggressive. So the list drops from 25 to 12. Now 12 stocks you can manage, and again you go from one after the other. You see one that's seemingly or looking like a pattern that you can trade, you bring it into your one of your stock boxes, and you follow it. And if you can find an entry, you trade. Let's go and see now an example. The best performing stock on Friday was let me see, SRRK. Okay, can we trade this SRRK? So again, it's not a given. This stock gaps up a lot. Now, can I trade it in the morning? No, because I'm not even looking at it. Okay, so now it's moving sideways for 6 hours. Okay, no trade here. Okay, but I still have another plenty of additional stock. Let's take a look at Top Golf. Okay, can I trade the Top Golf? Pretty much the same scenario. Sharp move higher in the morning, then it moves sideways. But here I have an opportunity. To me, okay, that's your own decision. To buy it here close to the VWAP with a very tight stop loss. So I'm buying it, let's say at 11.10 or 11.15 with a 5 or 10 cent stop loss. That's the 1%. So the stock basically is not doing anything. So basically I can gain here 1%. Okay, but let's say it's doing something else, and it closes here at the highs of the day at 11.60. So I'm basically buying at 11.10, close it at 11.60. That's 5%. I'm just making the routine of this type of trades. Take very little risk at support and let the trade run. If it doesn't run, and I didn't have enough time to talk about it. If it doesn't run, it can come back to the entry and you stop out and no harm, no foul. Worst case scenario, if it basically moves higher and then drops, you lose the 1%. So the 1% stop loss is crucial. Let me look at another trade. Again, all this list from Friday. Okay, now we're talking about FIGR. The stock is up. At one point, it hits the list, and the question is, where can I buy it? Can I buy it on the way up from 35 to 43? That here is an 8% move. Now, I'm assuming I cannot find it here. Maybe I can buy it at 40. Maybe, okay? Maybe, okay? But let's say I can buy it at 40. It goes from 40 to 40, nearly 44. So that's nearly 9% of movement. So I'm just pointing to the endless opportunities that you have as a day trader to implement this strategy. And again, it's something that you need to work on. It's, again, scalable, teachable, doable, whatever you want to look at the benefits of the strategy. There are drawbacks. You need to be, a good technical analysis, be very good with that, and you need to be very disciplined. Meaning, if the stop loss is more than 1%, you cannot take the trade. Okay? Don't exaggerate with the quantities. Stay at least for 6 months with the same quantity. Even if you're doing well, keep doing well. Practice, and then after 6 months, you made your increase your capital move from 20 to 30 or 25 per position. Again, The idea here is that you're building a business, and when you build a business, you do it carefully, you do it measurably, and you do it, and this, again, the most important part of this business, and this is manageable, scalable, and doable. Okay, guys, the 20 minutes, I have nothing more to say than good luck. If you want to take the class or / mentorship with us, please do email us. If you don't want to take the mentorship and you want to watch our videos, so be it. Do like and subscribe. That's super important for us. And we'll see you either on our next video or in the mentorship program. Thanks for watching, and we'll see you.